Yield is the topic of the day right now, and not just for real estate investors. It's also going to affect home buyers and sellers, but we're going to come to that second. This is Mondays with Mike, by the way. I'm Mike. We've talked on this series before about knowing your risk-free rate. That's when you buy a treasury bond, you're essentially lending the U.S. government money. That's considered to be risk-free, that the U.S. government is going to pay you back. If they can't pay you back, we have larger problems, and who knows what's safe to own at that point. So we just assume it's a risk-free rate. The 10-year treasury is what we normally look at because it's the benchmark for a lot of loans, including U.S. mortgages. And late last week, what we saw happening was we saw 2-year treasuries, meaning treasuries that are going to mature in 2 years, having a yield of, the high was, actually this was this morning, we hit a high of 4.351 as of this recording. And I went out a bunch of decimal places, but that means you're getting over 4% for a loan to the U.S. government that's going to be repaid within 2 years. Okay, on the 10-year, it's almost 3.79% as of this morning. So if you're a real estate investor and you're looking at what we call cap rates, it's really just not so fancy, but just jargon in real estate for your rate of return in the first year of a real estate investment. We're seeing as prices go up, those cap rates, those return rates go down. In New York City, it would be hard to find something that had a cap rate over 4%. Even in the outer boroughs in Long Island, those cap rates are getting compressed, meaning you're getting less and less of a return. Be careful of that. It's different if you have, another play, like you expect equity to rise. You're buying it at a really steep discount, and you're pretty sure that even if the market doesn't increase as much, you're going to see a nice return on equity. Or if you have a value add play, you're going to be, leasing it up with better tenants, paying more rent. That's a different investor profile, though, from those who are just looking to buy and hold real estate for a steady return. Remember, there are risks that come with owning real estate that don't come with just collecting your coupon payment from the U.S. government. You have risk of default, you have risk of vacancy, you have repairs that might need to be made, you have expenses that not just might, but will go up with inflation. That'll eat into your return. So keep an eye on that. Now, how does this affect people who are just looking to buy or sell? Well, like I said when I started, yield is everything right now. So if you're a home seller and you're thinking about selling and you have to buy, are you really going to be willing to trade in your mortgage that's under 3% potentially, likely even, for one that's more than double that? The end of last week, we saw 6.29% was the average 30-year fixed rate mortgage in the U.S. That's going to be a big jump in payments. In fact, and I'm going to look at the specifics here so I get this right. In August, the national median monthly payment was up 33% from January 2022. So that's a big jump. Now, the flip side of that, what can offset that for people that are looking to sell and buy, is if you've seen a nice rise in your equity, the value of your home, you probably have a much bigger down payment that you can put into the real estate if you don't need it for something else. So that can offset the payment, obviously. But that's not going to help our supply situation, which we've been talking about week after week after week. Getting sick of it, but this is it. We can't make up the news, right? We're just reporting it and helping you navigate it. The other big thing that I thought was kind of interesting that I'm reading about now is the cost of land in the U.S. has gone up. Maybe that's not a surprise, but they're kind of running out of developable tracts of land in these hot beltway cities. It's not that we're running out of land in the U.S. It's a huge country, but not all land can be developed for housing, right? So zoning, which we talk about that all the time on Long Island, it's not unique to Long Island, is an issue in all places. If you have people that are saying, no, in our community, we just want single family residences, well, you can't build as many as you could if you were, in Brooklyn or Queens or Manhattan, where you can have multifamily and multiple stories beyond just two. Not all land has plumbing, sewers, roads. These are all things that will take a lot of time to put in place in newer communities. So we also see a squeeze in other parts of the country where it normally was easy to just build a new development and keep the cost of housing down. We're seeing that squeeze applied in other parts of the country. In fact, land value in the U.S., the land, as opposed to the improved real estate, the house or the building, now accounts for 47% of property value. In 2012, it was only 38%. So in percentage terms, that's a pretty big jump. So cost of building and interest rates going up might rein that in a little bit, but long term, that's going to continue to be an uptrend also. So might want to think about buying land in hot cities if you're looking for an investment. But again, you're always going to look at your yield, going to check your risk-free rate, and when in doubt, you're going to ask a professional to help you out. Happy to answer any questions. I'll ask questions too. Probably have more questions than answers in our first conversation, but feel free to reach out. If you're seeing this on social media, please direct message me. Love to hear from everybody. And if you're seeing this via email, you probably have my cell, but you can email me back as well. Hope everybody is having a good Monday. If you're celebrating Rosh Hashanah, Shana Tova to you. Happy New Year. And talk to everybody probably next week. I'm going to try to make these as frequent as I can. Take care.